So Chapter 16, Introduction to Managerial Accounting. So in this chapter, we're going to define managerial accounting and understand how it's used, describe the differences between service, merchandising, and manufacturing companies, classify cost for service, merchandising, and manufacturing companies. We're going to prepare an income statement and a schedule of cost of goods sold, cost of goods manufactured for a manufacturing company, and calculate cost per item. And we're going to calculate our cost per service for a service company and cost per item for a merchandising company. So first, we're going to define managerial accounting and understand how it's used. This is a diagram just kind of showing you what the vision model is. This is called the Pathways Vision Model. And you've got the accountant over here trying to see, separate everything, this and that. And most people tend to think that accounting is boring. And you may too. But there's actually a lot going on. So if you like puzzles or putting things together or just having to, there's a lot of critical thinking involved with it in your day-to-day job life of accounting, or really anything in the financial market. And it shows you here, so you've got the economic activity, everything that's going on, critical thinking, you have to make judgment calls. So there is really no black and white in accounting. There's no this or that. There is a lot of in between. So a lot of times there may not be an absolute correct answer. So you have to kind of think through, using the information that you have, the relevant, useful information that you have, to determine what to do with that information and which direction to go. And you make good decisions or bad decisions. And you may not know necessarily that if there are bad decisions that are made, you may not necessarily know that they're bad decisions at the time. It may be something that you don't realize until a few months later, even a few years later. And this kind of goes back on if you think about budgets. So we take all of this information that we have to create a budget. We create that budget. We determine that, we're going to need this amount of money. Let's say you're budgeting to buy a car. You don't want to finance a car. You want to buy it with cash. So you decide this is how much money you're going to need to buy it. And then you budget the money to get it. But then something else happens. Maybe you need to use some of that money for something else. Or let's say it's a truck, because the cost of trucks has gone up a lot in the last maybe year or so. Well, you budgeted to save $10,000 to buy a truck, but now you can't find one for under 20. So, there's a lot more involved than just what you have. So sometimes you may make decisions that you think are good, but then they may not be. So it's all just this big kind of circle. But you can also make good decisions that are good. So don't want to scare you. So accountants are instrumental in helping to create a prosperous society. And if you're looking for job stability, almost every company needs an accountant or someone in that type of field. So not trying to push you towards being an accountant, but you are definitely in a good class, because regardless of if you decide to be an accountant or just know accounting, it is definitely something that is good for you to know, especially if you want to be a business owner or really just almost working in any profession that you do end up in. It's definitely good to have that knowledge. So there are two different types of accounting. There's financial accounting and managerial accounting. Financial accounting, you have financial statements that are used by investors, creditors, and government authorities. Financial accounting, we use financial statements. Investors, creditors, and government authorities use those statements. In managerial accounting, reports are generated for planning. So again, one planning tool is the budget. Controlling involves evaluating the plan and comparing the actual results to the budget. And weighing the cost against the benefit is called cost-benefit analysis. And we do this sometimes even in our own personal lives without even knowing it. You know, for instance, I may get on Amazon and I'll see something that I really want, and I've gotten better at not impulse buying, you know, because when we were stuck at home for so long, you know, but you know, I might put it in my cart and then I'll try to wait a couple of days and then go back and decide if I want it or not. And 9 times out of 10, I don't really want it. I just wanted it at that moment. But what I'll do is I may think of it, you know, unconsciously as a cost-benefit analysis. Well, you know, it costs this, but really I have something that already kind of does that, so maybe I don't need that right now. Maybe the cost is a little too high for how this is going to benefit me. So, yes, ma'am.
So does controlling and cost-benefit analysis mainly apply to managerial accounting?
Yes, ma'am. Yep. So, so under managerial accounting, these 3 dashes all apply to managerial accounting. Good question. And so here we just see it broken down a little more for us. So we've got on the left-hand side financial accounting, and on the right-hand side managerial accounting. And it lists who the primary users are. Again, know who those primary users are, and also the purpose of information. So for financial accounting, these are external users, investors, creditors, government authorities. They use financial accounting information to help them make investment and credit decisions. So they are, you know, you think of like a real estate investor wanting to purchase a home to turn it around and rent it out, or a creditor, you're looking to purchase a home and they want to make, or a company is looking to purchase some company vehicles. Well, they want to make sure that the company can, you know, afford those vehicles. They use relevant and faithful representative information, and they focus on the past. So they're looking at, you know, how you were able to, you know, support your company or support yourself if it's an individual in the past, as to whether or not they foresee you being able to continue to do that. Rules and restrictions, they're required to follow GAAP, and public companies are required to also be audited by an independent CPA. The scope of information for financial accounting, there are summary reports that are prepared primarily on the company as a whole, and usually on either a quarterly or annual basis. And then financial accounting, behavioral, the concern about adequacy of disclosures, and then behavioral implications are secondary. When you look at managerial accounting, again, that's used by internal people. So just like when you quickly think about it, to decide between the two, if you have a question that says, what's the difference between financial and managerial accounting? Or if you see a question that says, you know, who are the primary users of financial accounting? Or who are the primary users of managerial accounting? Managerial, think management, and management manages people that are in the business, so internal. So anything that may be listed that's external would not fall within the managerial accounting. So if you have a question that says, which of these is a primary user of managerial accounting, and it says investors, creditors, and coworkers or employees, it would be employees because they fall within that management role, in that internal role, which a manager would oversee the internal. Managerial accounting, the purpose is to help managers and employees plan and control operations. Managerial accounting, they focus on relevant information and focus on the future. So another difference here to kind of note, financial focuses on the past, managerial focuses on the future. Managerial accounting is not required to follow GAAP. And the scope of information, there's detailed reports that are prepared on parts of the company. So a specific department may have a specific report that they look at in managerial accounting, and these reports could be performed or created more frequently. So one company, for instance, an accounts receivable report for the receivables department, they probably want to see that report once a week because they want to be able to get in touch with the customers that aren't paying. Whereas, when we mentioned financial accounting, those reports are normally performed or created a little less frequently. And then behavioral, for managerial accounting, there is a concern about how reports will affect employee behavior. And that can kind of go back to the AR, the accounts receivable. So if we're running an accounts receivable report every week and we have employees that their job is to ensure we are receiving our money on time, and our accounts receivable report is getting bigger because customers aren't paying us, that could potentially affect our employees' behavior and reduce their morale because they feel like they may not be doing their job well enough because their job is to keep that report small to get all of our money. But with that report growing, so it can negatively affect their behavior, or you can look at it on the other end. Let's say that report just keeps getting smaller, and it used to be a 10-page report, and now it's a 5-page report. That could positively affect our employee behavior. So just kind of giving you an idea of that. So, and those are all listed within managerial accounting. Management accountability is the manager's responsibility to the various stakeholders to wisely manage the organization's resources. Stakeholders have an interest in the business and include, and then we have a list here of different types of stakeholders. Customers are stakeholders, creditors, suppliers, and investors. I think normally when we think of a stakeholder or a shareholder, we think of a stakeholder, and I know I personally, just go straight to an investor. An investor has a stake in the company. They put money into the company and they have a stake as to whether or not that money is going to go up or down. A lot of times we don't realize that customers, creditors, and suppliers are also our stakeholders. So, definitely kind of keep that in mind because a customer is purchasing a product from your company and therefore they have a stake in your company. Even if it's no matter what type of product it is, how big, how small, how long it's supposed to last, they do have a stake in your company once they purchase that product from you. And suppliers, same thing, they're supplying supplies to you to make those products. I think those are the two mostly forgotten, are customers and suppliers. So. Management has an accountability to their stakeholders. So when we kind of break down the different activities within a company, we have our operating activities, investing activities, financing activities, and then there are different actions that affect society. When we look at our operating activities, our stakeholders are our suppliers, our employees, and our customers. Without supplies, we can't operate. Without employees, we can't operate. And without customers, we can't operate. Because there's no point in creating something that no one wants to buy or use. So just to kind of give you an idea, because again, you want to know what categories all of these fall into. So just note, you can't operate without someone that purchases your product, creates your product, or without the materials needed to create your product. Those all fall within operating. Suppliers provide your products and services, and management's accountability to the suppliers is to make sure that we are making timely payments for our supplies. If we don't make timely payments for our supplies, does anyone know what could happen? They stop supplying. Yep. And I have seen this, you know, where a company, especially over the last couple of years, where a company really needs a supply because they have this huge order that came in, and they need to create the product for this big order that came in, but they don't have all the supplies they need. And the supplier that sends them some of the main material that they need in order to create that supply, they said, nope, your order's on hold until you make this payment. And it wasn't actually the company's fault. They actually did make the payment, but I don't know if any of you guys had issues with mail. This was about 2 years ago. But a lot of the mail was getting lost in somewhere. And so the company had to, you know, void that payment, reissue a check, send the check to them, and to have them release the order. But regardless of the reasoning behind why they didn't make that payment, because they didn't make that payment, that put that supply order on hold, which slowed down the company making the product, which slowed down the company getting the product to the person that, the company that ordered it from them. And not only can that affect the relationship with their supplier, but now that they've been slowed down on creating this product, that could also negatively affect the relationship with their customer, because now their customer may, you know, they were like, well, you promised you were going to have this to me within 5 days, and now it's taken a week or, you know, so to get this product. Now they may go look for another company to create the same product because of timings. So it's very, very important to make sure that if you are able to do so, and I understand like financial issues arise and stuff like that, but if you are able to make timely payments to your suppliers, you know, because it's kind of just a trickle down effect. It can affect other things. Employees also fall within operating activities. And employees, they provide their time to the company, and they also provide their expertise. Management's responsibility to their employees is to provide a safe and productive work environment and to pay their wages and salaries. Customers, they provide the cash. They purchase products from us, we get their cash. Our management's accountability is to provide products and services that are safe and free of defects, and to back up the products and services that they provide. So if they do happen to provide a faulty product, or if, you know, a service is done poorly, it's management's responsibility to try to fix that, to send out a replacement product, issue a refund. If it's a service, to send somebody out there to fix whatever the service issue was that, you know, maybe wasn't fixed the first time. And all of these, even though it doesn't say it, all of these really kind of, they also affect the business's like overall approval rating. So, suppliers, if we aren't timely paying our suppliers, that can look bad on the company. Employees, if we're not taking care of our employees, providing a safe work environment, paying them on time, that can look bad. They're going to go look for a job somewhere else potentially. And then customers, same thing. If we're not providing good services and products to our customers, they're going to stop shopping with us. They're going to tell their friends not to shop with us. So we definitely want to make sure, so it's management's responsibility to make sure that we are staying on top of these things. And then we look at investing activities. And in investing activities, we have our stakeholders are our asset vendors. And our asset vendors provide our long-term assets. Does anyone know what a long-term asset is?
No.
Does anyone remember what a long-term asset is? How about a short?
I know that asset is something that you own.
Yep.
Something that you can own.
So an asset is something that you own. So when you think of an asset, are there any examples that come to mind?
Cash,
Cash, land, buildings, cars. So those are all assets. And then what about long term? So we have short term and we have long term. What is short term? Do you remember? So short term is anything within a year. And long term, kind of like current and long term, sorry. Current and long term, or short term and long term. Short term and current are interchangeable. So current assets within a year, long-term assets a year and over. So anything over 12 months, that would be sitting on your books. So when we mention investing activities for long-term assets, we're thinking of an asset that we are going to have on our books for over a year. And some examples of long-term assets that we would probably have for over a year would be, like you mentioned, land. More than likely a vehicle will last us longer than a year, so more than likely that would be considered a long-term asset as well. And then so on our investing, and then also if we have any investments, you've got your short-term investments and you have long-term investments. So if we have any long-term investments, those will also be sitting there for over a year. And so under our investing activities, when we think of asset vendors and we look at long-term assets, management's responsibility is to make sure that they are making timely payments to those vendors. When we look at financing activities, under financing activities, we have investors and creditors. And kind of mentioned this earlier, but investors are people that are investing in our company. You can think of like buying a stock within the company. And then creditors are people who are lending money to the company, which they're kind of also investing in the company in a sense as well. They're lending us money. But with our financing activities, we have investors who provide cash and other assets, and management's responsibility is to provide a return on investment. So they're investing in our company, and in return, they are hoping to get a return on their investment. They give us $1,000 and they're hoping to get back more than $1,000. Why else would they give us money? They want to make some, right? I mean, so that's just how that works. So management's responsibility is to try to ensure that they are getting a return on their investment. Because if they don't get a return on their investment, saw this recently in the stock market as well, then they're going to sell their stocks and they're going to go somewhere else. And then you're going to see a big red drop. So definitely trying to ensure that your investors are getting a good return on their investment to keep those investors and also hopefully grow those investors. so that your company has more funds to grow as well. Financing activities with creditors. Creditors also provide cash, and management's responsibility for our creditors are to repay the principal and the interest. So when you think of purchasing a car or a house, you know, we pay the amount for whatever it is. So let's say it's a car and it's $10,000. Well, we're paying $10,000 for the car, but then there's also going to be some interest fees because we're financing it. So management's responsibility is to make sure they pay back the principal, that $10,000, plus any interest as well to those creditors. And then actions that affect society. You have governments and communities. And governments, they provide permission to operate. Management must ensure that they are obeying laws and also paying taxes. For communities, communities provide human and physical resources. And management's responsibility to communities is to operate in an ethical manner in support of the community, ensuring that the company's environmental impact does not harm the community. So today's business environment, we are shifting towards, or have shifted towards, a service economy. And there's a lot of competition. So one type of competition is you have time-based competition, and listed within time-based competition, you have enterprise resource planning, or ERP systems, and the ERP systems help to integrate companies' data. You also have e-commerce, which allows companies to sell products to customers all over the world. And you have just-in-time, JIT management, which is an inventory management tool. Total quality management, TQM, is a philosophy of continuous improvement in products and processes. Total quality management creates a culture of cooperation. Each step adds value to the end product, and it's referred to as the value chain. The economic, social, and environmental impact of doing business is referred to as the triple bottom line. And the triple bottom line, or the 3 Ps, is profits, people, and planet. On this slide, this is just going over ethical standards, which are important. It's important to know, you know, what the ethical standards are, and ethics are, you know, pretty much used in every business. But definitely read over this. I am going to mention, you know, the bolded areas. So competence. Competence is, you know, you being competent enough to perform the job that you're doing. Management accountants have a commitment to ethical professional practice, which includes principles of honesty, fairness, objectivity, and responsibility. The standards of ethical practice include competence, confidentiality, integrity, credibility. Confidentiality is where you know, confidential, you keep certain information confidential. It's not supposed to go out to the public or everyone unless there's a disclosure that's legally required. Under integrity, just, you know, refraining from engaging in any conduct that would, you know, negatively impact the business. Credibility, communicating information fairly and disclosing any relevant information that could reasonably be expected to influence or intended for your user's understanding of the reports. So we're going to go on to objective 2. In objective 2, we're going to describe the differences between service, merchandising, and manufacturing companies. So how do service, merchandising, and manufacturing companies differ? Service companies sell their time, skill, and knowledge. All of their costs are period cost and are expensed in the period incurred. Merchandising companies resell products that they previously bought from suppliers, and their cost of goods sold is an inventoriable product cost, which is also called a product cost. Manufacturing companies create products that customers want. So, can anyone give me an idea or an example of, a service company? I'm sorry? Enterprise. And their service is they're supplying vehicles to people that need to rent a vehicle. Good job. What about a merchandising company, a company that resells products they previously bought? Yep. There's a lot of those. Yep. What about a manufacturing company? This one may be a little more difficult.
I don't know if you maybe one, but you know, the car dealerships.
Mm-hmm. Like the car, not the car dealerships, but the car, what is it called? The car manufacturing plants, like Kia.
What
Yeah.
about General Electric?
What do they do? Hold on. Do they put together?
They do like some of everything, like they have.
I think they do a little bit of everything. Yeah.
The washing machines and dryers and stuff like that.
But they have an actual location where they put together all the parts, like an assembly line or something, and then they sell them as well, don't they? Yeah. That's what you do when you get big enough to create the product and sell the product yourself, and you're not having to pay like middlemen to do that, and you're keeping all that in-house. Very good. So manufacturing companies convert raw materials into finished products. And there are 3 types of inventory. You have raw materials inventory, work in process inventory, and finished goods inventory. And our raw materials inventory, this is where we have all of our materials that are used to manufacture a product. So our raw materials inventory account, we're going to have all the different parts that we need to create a car. So we may have, you know, a door and tires and rims sitting in our raw materials inventory account. And then our work in process inventory account, these are goods that have been started but are not complete. So in work in process inventory, we are making a car and we are going to pull all those parts into our work in process area. We're piecing that car together. So now we've got, you know, our tires and our rims and our door and everything just in this account, this work in process inventory account, while we're putting the puzzle together, creating the car. And then once it's done and it's completely ready to go, finished, ready to sell, we're going to move it out of that work in process inventory account to our finished goods inventory account. So now our fully completed car that runs and is ready to go and ready to sell is sitting in our finished goods inventory account. This is completed goods that have not yet been sold. This is a diagram showing you the difference between service, merchandising and manufacturing companies. And so we see here we've got an income statement on the top line, and we've got our balance sheets on the bottom area for a service company, a merchandise company, and a manufacturing company. And so we see here they all look a little different. So an income statement for one company may not be the same for another company. So when we're looking at the service company, they have their service revenue, and then they have on their income statement, and then they have all of their expenses listed out. So they've got their salaries expense, rent expense, utilities expense, and then taking their revenues minus their expenses gives them their operating income. When we look at a merchandising company, we have their sales revenue. So now we're looking at sales revenue. And they're a merchandising company, so they also have a cost of goods sold. And in their cost of goods sold accounts, they're going to have a beginning inventory account, purchases, anything that they bought, cost of goods available, which gives them their cost of goods available for sale, and then whatever their ending inventory is at the period will then allow us to figure out what their cost of goods sold is, which is going to end up at our gross profit. But then they also have some selling and administrative expenses, and then when we take those out, we're left with our operating income. And when we look at a manufacturing company, it's kind of similar to the merchandising company. So we see here we've got our sales revenue, we've got our cost of goods sold, and again we see here we've got our beginning finished goods inventory. In cost of goods sold, we have our beginning finished goods inventory and our cost of goods manufactured, which gives us the total cost of goods sold that we have that we are available to sell. And then we're going to take out our finished goods inventory, which is going to give us the cost of goods that we actually sold. We're going to take that from our revenue so that to come to our gross profit, which here is $4,000. And then again, we also have our selling and administrative expenses. Take those out, and we're left with our operating income. When we look at the balance sheets, there are also some similarities and differences here as well. So for a service company, you have cash, accounts receivable, equipment, and then that gives us our total assets. For the merchandising company, again, we have our cash and accounts receivable, and we also have equipment, but we also are adding in our merchandise inventory. So we also have merchandise inventory on the balance sheet for our merchandising company. And then for our manufacturing company, we still have cash, accounts receivables, and equipment, but for manufacturing, on our balance sheet, we're also going to show our raw materials inventory, our work in process inventory, and our finished goods inventory. Bless you. So, like when you look at merchandising, you see here we have sales revenue of $7,000 minus our cost of goods sold gives us our gross profit. So, oh, that's terrible. That's supposed to be a dash or a minus sign. So if you have a question that asks, what is the gross profit for a merchandising company, you can refer back to here to see how they came up with the gross profit. Sales revenue minus your cost of goods sold equals your gross profit. If you have a question that asks about your cost of goods sold, you have your cost of goods sold account here. To find your cost of goods sold, this is how you find it. You take your beginning finished goods inventory plus your cost of goods manufactured. I can draw this in here. And then you're going to subtract out your ending finished goods. And that's going to give you your total cost of goods. So these are also kind of like, you can also kind of look at this as the equation as well to kind of see how they came up with what they came up with. So this is our cost of goods sold, 3,000. How did we get 3,000 for our cost of goods sold? Well, we took the beginning inventory plus the cost of goods manufactured, which gave us our cost of goods available for sale. Take out the ending inventory. This is the cost of goods that we actually sold. You may even see a question that says, what was the cost of goods available for sale? Well, it tells us right here to find our cost of goods available for sale, we take the beginning finished goods inventory plus the cost of goods that we manufactured, and that gave us the cost of goods that were available for sale. So this is just more of like a visual area that we can visually look at and see the equation and how to perform that. And let's see. Down here, you can kind of do the same thing. So it's just kind of showing, like if you have a question that says, you know, like for the manufacturing company, you know, what were their total assets? Well, we see here we've got all of the assets listed out here: cash, accounts receivable, merchandising, inventory, and equipment. So we would just add all of those up to get to our total assets. So all of these would be added, and that would give us our total assets. Learning objective 3, classify costs for service, merchandising, and manufacturing companies. So how are costs classified? You have product cost, you have direct cost, you have cost that can be directly traced to a product. That would be a direct cost. And you also have indirect cost, and indirect costs are costs that cannot be easily traced to a product. There's no way you could possibly read that without me telling you that on this slide, probably.
So there's only direct cost and indirect cost?
Yes, ma'am. So you have product cost. You have the different types of product cost are direct cost and indirect cost. And a direct cost is a cost that can be directly traced to a product. An example of a direct cost is direct materials and direct labor. So when we go back to the car example, the person that is actually assembling the car would be direct labor. Their wages, their salaries would be within that direct labor because they are directly assembling the car. It can be directly traced to the car. The direct materials would be any materials that are directly used for that car. So the tires, the doors, the windows, those are all direct cost. Indirect cost are costs that are not easily traceable. So when you think of manufacturing overhead, that is an indirect cost. So different product costs, you have your direct materials, direct labor, and manufacturing overhead. And you may see these abbreviated in some areas, DM, direct materials, DL, direct labor, MOH, manufacturing overhead. Direct materials are the raw materials that are used in production. Direct labor, that's the labor of the employees who are working on the products, physically putting the product together. And manufacturing overhead is indirect. It's the indirect product costs that are associated with production. This includes your indirect materials, indirect labor, and factory cost for things like your rent, utilities, and insurance. So here we have a slide telling us about our product cost. We have period and product cost for Smart Touch Learning. That's the name of the company that we're going to use throughout this chapter. And so we're listing out some costs that we have incurred, and we're also identifying whether or not those costs are considered period cost or product cost. We have our period costs are anything that is selling and administrative. So period cost, they are not directly related to the product. So when we look here, it says our depreciation on office equipment, that's considered a period cost. Any advertising costs that we have would be a period cost. If we have property taxes and insurance on our office space, that's also a period cost. The CEO, who oversees everything in the company, he's not directly associated to like one product. He's overseeing every product in the company because he's over everything. That CEO salary would also be considered a period cost. But if you just kind of sticking here with the salary, the product cost category, that's where like your production supervisor salary will fall, because they're overseeing the production of the product. So that's why his salary falls under product. So a period cost is like your advertising. So when you're advertising to sell the car, but the advertising cost did not go into actually physically making the car. And advertising, we're normally paying in a certain period. So if it's a monthly period, you normally pay for advertising once a month. So that's why it would be called a period cost, but it's not. Advertising isn't going directly into the car. The tires are going directly into the car. And what we're paying the people to put the car together is going directly into the car, but not the advertising. It also like one that's more easier to see would be like depreciation on office equipment. Like you're not going to see the depreciation on office equipment going into the car. So that's why that's a period cost as well, because that's not actually physically going into the car. And we'll talk more about this, and I think as we talk about it, it may be a little more clear, hopefully, and if not, we can come back to it. So under period cost, we stopped at CEO's salary. If there's a delivery expense will also fall within your period cost. Under product cost, we have direct materials, direct labor, and manufacturing overhead. For product cost, direct materials, some examples would be the batteries or processors. If there's any other materials that are used. So Smart Touch Learning is a tablet company. So Smart Touch Learning creates tablets. So direct materials for creating their tablets, a tablet needs a battery, a processor, and other materials that may be used to create a tablet. So those are all direct materials. If there is a freight cost on purchasing the materials used to create the tablets, that freight cost to get those materials to put the tablets together is also going to go into our direct materials account. Direct labor, so the employees that are putting together the tablets, they're going to fall in here in direct labor. Manufacturing overhead, so if we have any depreciation on our manufacturing equipment, the equipment that we're using to put the tablets together, that's going to fall under our manufacturing overhead account. Property taxes and insurance on the factory will fall in manufacturing overhead. The supervisor's salary for that is overproducing the tablets will also fall under manufacturing overhead. And any manufacturing supplies will fall under our manufacturing overhead account. So kind of like looking at these accounts to try and see the differences between them. So when we look at depreciation on manufacturing equipment, this is specifically referring to manufacturing. So this is referring to creating the product, manufacturing. This is the factory. We use the factory to create the product. Production supervisor supervises the creation of the product. The assembly line workers create the product. All of these items are used in making the product. These supplies are also used to create the product. And these costs are associated with getting the materials needed to create the product. So everything that I just underlined, these are all going to be considered product costs, and this is why. So this is used to manufacture the product, so that's why it's considered a product cost. Property taxes on the factory, we have to have the factory to create the product, so it's considered a product cost. The production supervisor's salary, we need the production supervisor to produce the product, so his salary is considered a product cost. The assembly line workers are needed to put the product together to assemble it, so their salary will fall within our product cost. Batteries and other items that are needed to create the product are product costs. Manufacturing supplies, these are the supplies that we need to create the product, those are product costs. And whatever freight, shipping costs that are associated with buying the materials to create the tablets, those are also product costs. These other items, these are considered period costs. They're not directly associated with the product. So like the depreciation on office equipment. When you think of office equipment, so the company we're looking at creates tablets, but they have an office. So let's say this is their office. We've got a computer in here, we've got a board, a whiteboard, books, pens, pencils. So the computer is considered office equipment. But the company that's creating the tablets, they're not using, this room is our office, this is our office equipment. The company that's creating the tablets, they're going to have like some big machine or something, probably, more than likely, that they're putting all this stuff together on. So depreciating on our office equipment, our desk and our computer in the office is not directly associated to creating the tablet. So that's going to be a period cost. Our advertising that we're paying, it is not something that's going into the creation of the tablet. It's just something, after we create the tablet, now we're marketing our tablets, but it's not necessarily, it's not something that was required in order to produce the product. So that's a period cost. Our property taxes and insurance on our office space, nothing to do with the actual, what we had to put into the product, so that's a period cost. Our CEO's salary, not directly associated to the product either, so that's a period cost. And any delivery expenses that we may have are not directly associated with putting the product together, so it's not, it's going to be a period cost as well. So maybe just kind of going back and just looking over the slide to kind of have an idea of you know, what's considered a period cost or what's considered a product cost, and just kind of thinking through that. If it's something that's necessary in order to create the product, more than likely it's going to be considered a product cost. So prime and conversion cost. I really like this little diagram down here. Hopefully that helps you guys. But you have prime cost and you have conversion cost. And we see we have our direct materials, our direct labor, and our manufacturing overhead accounts. Our direct materials falls directly under prime cost. Our manufacturing overhead falls directly under our conversion cost. Our direct labor falls in the middle. So prime cost combine our direct cost of direct materials and direct labor. Prime cost combines direct materials and direct labor. Our conversion costs are the cost to convert the raw materials, I'm trying to switch gears to the tablet, the keyboard and the screen, the raw materials, into finished goods, the tablet. That's the conversion cost, to turn the raw materials, the screen, the keyboard, into finished goods, the tablet that's ready for sale. Those are conversion costs. Direct labor plus your manufacturing overhead. Direct labor plus manufacturing overhead gives you your conversion cost. So again, if you kind of look back here, so if you have a question that says, what are the prime costs? You're going to take your direct materials and your direct labor. What are the conversion costs? Conversion costs are your direct labor and your manufacturing overhead. All right, so we are going to prepare an income statement and schedule of cost of goods manufactured for a manufacturing company, and also calculate the cost per item. So how do manufacturing companies determine the cost of manufactured products? So we're looking here at the income statement, and we're going to calculate the cost of goods sold. To calculate the cost of goods sold, we take the finished goods inventory account that provides information for the cost of goods sold section of the income statement. So you're going to take your gross profit equals your net sales revenue minus your cost of goods sold. And we saw this earlier in that earlier slide when we were looking at the income statement, and we saw the sales revenue minus cost of goods sold equals our gross profit. I think that was slide 16 or something. But your sales revenue minus cost of goods sold equals your gross profit. And then your operating income, to find your operating income, again, this was also on that slide, we took our gross profit and we subtracted out any sales and administrative expenses, and that gave us our operating income. So here we have an example of an income statement, and we've got our sales revenue, we've got our sales returns and allowances, any sales discounts, those equal 200,000, and then we're going to subtract the sales returns and the sales discounts from our revenue, to give us what our actual net sales revenue was. And the reason we subtracted that was because sales returns, that's when a customer has purchased an item, so it went in our revenue account, but then they returned the item, so it needs to come back, it needs to come out of our revenue account because they've returned it to us and we've sent them their refund. Sales discounts, that's where maybe we had a sale and we told everyone they could buy something, buy one, get one free, or buy one and get one for 50% off. So the discount is going to need to be taken out of our revenue as well because it's not part of our revenue. We would normally make $100 on this product, but we sold it for $50. So when we sold it, we still recorded it in our revenue account as $100, but we discounted it $50. So we need to take that $50 discount out of our revenue to find what our actual net sales revenue was. And then we're going to subtract out our cost of goods sold. And if you have cost of goods sold, it's going to be broken out on your income statement. So this is our cost of goods sold account. This is all the activity. That's all of the activity in our cost of goods sold account to give us our actual cost of goods sold. So to find our cost of goods sold, which was $600,000, we took our beginning finished goods inventory and our cost of goods manufactured, which told us that our cost of goods available for sale was $660,000. And then that's what we had available for sale during the period. At the end of the period, we had this $60,000. So that means the cost of goods that we actually sold was $600,000. We started with zero. We manufactured $660,000. We ended with $60,000. So that means we sold the difference, which was $600,000. And so now we have our cost of goods sold and we have our net sales revenue. So our net sales revenue minus our cost of goods sold is going to tell us what our gross profit is. And then we have our selling and administrative expenses. So we're going to subtract out all of our selling and administrative expenses. So here we are listing what those expenses are. We have wages expense, rent expense, insurance expense, all of these expenses. We're going to total those out, which gives us $241,000. That's the total selling and administrative expenses that we had. And then we're going to subtract that total expense from our gross profit, which tells us that our operating income is $159,000. And then if we have other revenues or other expenses, then those would be recorded here. And in this case, we do have an interest expense. So we're going to subtract out our interest expense, which is going to give us our earnings before income and taxes. So our earnings before income and taxes is $151,440, $151,400. And then we're going to subtract out the tax expense of $53,000. And we are left with our net income of $98,400. So this is a good kind of like visual way to see how to calculate everything. You can see how it lands on the income statement, but it's also a good way to kind of see like how we calculated the cost of goods sold, how we calculated the operating income. And then just note that cost of goods sold is a product cost, and salaries and administrative expenses are period cost.
What was the second one?
Salaries and administrative expenses are period cost. And this is slide 24, if you wanted to refer back to it. Cost of goods manufactured is the manufacturing cost of the goods that the finished production process in a given accounting period. The cost of goods manufactured costs are determined from activities that took place in the past. This is another kind of diagram, kind of helping you to see the calculation of the cost of goods manufactured. So here we have our product cost, and in our product cost you have any raw materials that you purchased plus whatever the freight in charges were. So when we think of the tablets, we purchased the keyboard for the tablet, and the keyboard was shipped to us for, I don't know, we purchased the keyboard for $10 and the shipping charges were $5, so that $15 would be included in our purchase of raw material plus freight in, because it's the purchase of the raw material plus the freight in. In our product cost, we also have whatever the direct labor was. So I'm physically putting these tablets together, so my labor, my salary, is going to be associated with the product cost to make the tablet. And any manufacturing overhead, we're using this building, this room, to put it all together. So the manufacturing overhead in this room is also going to be included in the product cost for the creation of the tablet. So when we look at our balance sheet, we're going to see an account called raw materials inventory, work in process inventory, and finished goods inventory. These three accounts will appear on our balance sheet. And while when we're receiving the materials, we're getting, we've got this will be our raw materials area. So we've got all of our material parts. We've got our keyboards and our screens, all of this just sitting over here ready to go. This is our raw materials inventory. Whatever the items are that are sitting in this raw materials area, they're going to sit on our raw materials inventory account in the balance sheet. And then we have this section right here where they're actually putting all of those items together and we're creating the tablet. So we're working on the tablet, we're working on creating the tablet. So we're pulling these pieces from our raw materials. Okay, we need a keyboard, we're going to pull that out and put it in our work in process. We're going to pull this screen out and put it in our work in process. We've got this person piecing all of this together. Their salary is also going to be in our work in process. And while the items are sitting in work in process being worked on, they're going to be in that work in process inventory account, and that includes the direct labor and the manufacturing overhead of the building that we're using to create the product. And once we've completed the tablet and it's ready to go to the store, be shipped off, sell, now we're going to move it over here, and it's sitting now. This is our finished goods area. So this is our finished goods inventory. It's no longer in work in process. It's now been moved over to finished goods and it's ready for sale. Once we sell the product, so now we've sold it, it's going out the door, it's gone. So we've sold the product. It's no longer in our physical presence. The money that we receive from selling the product is going to, the cost associated with it is going to go to our cost of goods sold. We're going to receive sales revenue based off of the price that we sold it for. So we sold it for $100 and it costed us $20 to actually put it all together. So we're going to have $20 sitting in our cost of goods sold because that's what the cost was. We sold it for 100, so we have 100 here, minus the $20 for the cost of goods sold, gives us an $80 gross profit. And then if we had any selling and administrative expenses, we would see those here in our period cost area. We would subtract those out, and that would we would end up at our operating income. Cost of goods sold is part of the product cost because this is all related to creating the product. Raw materials, work in process, finished goods. Product cost creates a product. Those product costs go into our cost of goods sold account. That's why it is considered a product cost account. And then selling and administrative expenses are not considered product cost. They are period cost. So when we calculate the cost of goods manufactured, we start with our beginning work in process inventory. We have listed here all the different direct materials that we used. So to determine your direct materials account, you're going to take the beginning raw materials inventory plus whatever purchases of raw materials, including your freight, which is going to give you your raw materials that are available for use. Then you're going to subtract out whatever the ending balance of that account is at the end of the period. So at the beginning, so this is year ended December 31st, 2018. So at the beginning of the period, we had 70,000. During the period, we purchased 350,000. So at the end of the period, during this period, we had available for use 420,000 that we could use. And at the very end of the period, we realized we only have this amount left, 65,000 left in our account. So to figure out what we actually used, we're going to take what we had available to use minus what we had left at the end of the period on December 31st, and that gives us what we actually used, which is the 355,000. And then we also have our direct labor, our manufacturing overhead, our total manufacturing overhead. This is going to show us how to calculate that. So this was our direct materials, and this is our manufacturing overhead. So for our manufacturing overhead, we have our indirect materials of 17,000, our indirect labor of 28,000, any depreciation on our plants and equipment, depreciation is 20,000, our plant utilities, our insurance, and our property taxes, which are 18,000. And all of those together are going to total our total manufacturing overhead, which is 83,000. So manufacturing overhead, think of anything not directly associated with creating the product. So you've got, your building, the plant utilities, so your power, your water.
Those categories won't always be the same, right? Like on every sheet
you won't see these on everything. Kind of like when we had looked at, let's see, this is 27.
Just another foot line to add all those manufactured overhead to give you total.
So like when we look back here at this one, depending on the type of company that you're looking at, your income statement could be different. Your balance sheet could be different. You're not going to have the same accounts every time. And honestly, sometimes you're going to have the same type of account, but the name is going to be different. It just depends on the business and how they set up their chart of accounts. Each of these is an account listed on your chart of accounts. So, for instance, and this is on the PowerPoint that is not being shared on the screen for recording purposes. But so when we look here at the income statement for the service company, we have our service revenue account. Some companies may just call that revenue. So the name can be slightly different. Or rent expense could be, listed out differently. Salaries expense, utilities. Utilities expense is normally broken out. So you have your utilities expense, but then you'll have within that category the actual utility. So power, water. And then in some cases, it may, instead of being power, it could be like Georgia Power or, something like that. So they will be different. They can be different. They may not always be the same. They may not always be the same because the naming convention used, the chart of account name that's used, they could also be different because of the different type of company. Like we see here, we have service company that just has our service revenue, salaries expense, rent expense, utilities expense. And then when we look at the merchandising company, they also have cost of goods sold, and they've broken their cost of goods sold out between beginning, inventory, purchases, cost of goods available for sale, ending inventory. So it depends on the type of company as well. And so we have our beginning work in process inventory of 80,000. We're going to add in the total manufacturing costs that were incurred during the year, which is the 607,000, and that's going to give us our total manufacturing cost to account for total manufacturing cost of 687,000. And then we're going to subtract out our ending work in process inventory of 27,000, and that's going to give us our cost of goods manufactured of 660,000. So this is showing the flow of cost through the inventory account. And again, if you are working on a problem, this is slide 28. If you're working on a problem that asks, what is the ending inventory, or what's the cost of goods manufactured, what's the total manufacturing cost to account for, any of these, I would definitely refer back to the slide. This is going to show you, this is showing you how to calculate all of that. So when we start creating the tablets, our items are in our raw materials inventory account. So in this example, our beginning inventory is 70,000, and we've bought some items. So our purchases and freight in are 350,000. We're going to add that together to get our direct materials that are available for use. And our direct materials available for use is $420,000. We're going to subtract out whatever our ending inventory is at the end of the period. And that's going to leave us with the direct materials that we actually used. And we used these direct materials. So these direct materials, we pulled them, we're using them. They're no longer in our raw materials inventory account. Now they're going to our work in process inventory account. So we're pulling them out of direct materials, raw materials, pulling them out of raw materials, and we're putting them in work in process. So our work in process inventory account, our beginning inventory was 80,000. we've just added this $355,000 for our direct materials used that we pulled from raw materials. Now it's in work in process. We're also going to add in the direct labor for the people that are putting these tablets together, $169,000. And the manufacturing overhead, the overhead for the building that we're using, of $83,000. And that's going to tell us that our total manufacturing cost to account for that period for our work in process inventory is $687,000. Then at the end of the period, we had $27,000 left. That means we have to figure out what we actually used. So we had $687,000. We now have at the end of the period $27,000. So that means the actual cost of the goods that we manufactured during this period in our work in process account that we created was $660,000. So that's our cost of goods manufactured. We have manufactured these goods. They're ready to move to our finished goods inventory account. The cost of those goods was $660,000. So we're going to move that $660,000 to our finished goods inventory account along with the finished goods. We're moving those, we're physically moving the goods there, and we're moving the funds, the money there in our books. So our beginning inventory in our finished goods account was 0. And then the cost of goods manufactured that we manufactured here was $660,000. So we've moved that over to our finished goods inventory account. We're going to add our beginning inventory plus our cost of goods manufactured, which gives us the cost of goods that we have available for sale. So we have these goods here that are available for sale sitting in our finished goods inventory account of $660,000. And at the end of the period, we were left with $60 in that account, which means that the cost of the goods that we actually sold was the difference of the two. So the cost of the goods sold was $600,000. So we still have in our finished goods inventory account, we still have $60,000. We still have some of the tablets. But we sold quite a bit of those tablets, and the cost of goods that were actually sold was $600,000. So we have $60,000 still sitting here, and we sold $600,000. Calculating unit product cost. Managers make decisions on pricing products based on unit cost. So the cost per unit is found by dividing the cost of goods manufactured by the total units produced. The cost per unit is used to determine the cost of goods sold for the units sold to customers. So we see here we have this example. We sold 2,000 tablets. The cost per tablet was $300. So the cost of goods sold is $600,000. So the number of units sold times the product cost per unit equals the cost of goods sold. So if the cost of the tablet was $300 per tablet, and we were trying to figure out what the sales price of the tablet should be, what would be a good sales price for the tablet? If it cost $300 to make the tablet, what would be a good sales price for the tablet? Would we want to sell it? Would a good sales price be $250?
No, $50.
Would a good sales price be $350?
No.
No?
It'd be a profit, right?
A small one.
Right.
So if we, so we have a tablet, it cost us $300 per tablet, and we're gonna sell the tablet. Should we sell it for $250?
No.
Should we sell it for $350?
No.
Why not 350?
We could, but it's still more than.
That's more than what we paid for it. Right?
It's more than what we paid to create it.
Right.
So you would want to sell it. So a good sales price would be anything over $300. Because that means we're making something off the product. So even if we sell it for $301, we're still making $1. Now, of course, we probably want to make more than $1 off of it, but you know, anything over 300, we would be making something. Let's say we make the tablet for $300 and we sell the tablet for $300. Does anybody know what that's called?
Right, say that again.
We create the tablet for $300 and we sell the tablet for $300. What is that called?
You're not making any profit. So
You're not making any profit, you're not losing any,
Breaking even.
breaking even. So your break-even point would be to sell this tablet for $300. You're not making anything, but you're not losing anything either. If you create the tablet for $300 and you're selling them for less than $300, you're selling them at a loss, so you're losing money. So you want to sell them for more than $300. And these are types of decisions that managers have to make. You know, they have to decide what they're going to price the item at. And, you know, sometimes they base it on, normally this is based on a few different things. Part of it is the unit cost, how much it costs to actually make the product. And, you know, a lot of times they also factor in the market, competitors, and stuff like that as well when trying to price their items. But if you don't look at this, if you don't make your decision based on your unit cost, you could potentially price your item too low or even maybe too high. So you definitely want to look at all the factors when you're pricing your items. So now we're going to calculate the cost per service for a service company and cost per item for a merchandising company. So how is managerial accounting used in service and merchandising companies? Managers of service and merchandising organizations make decisions on pricing based on cost per service or cost per item. And so here we see we have a total cost of $3,900. And we have provided 1,950 services. So to figure out the cost per service, we're going to take the total cost of $3,900 divided by the total number of services that we've provided, 1,950. And that tells us that our unit cost per service is $2 per service. And you apply the same type of math to find the unit cost per item. So we're going to take the total cost of goods sold, which in this example is $90,800, total cost of goods sold, divided by the total number of items that we sold. So we sold 260 tablets. So the total cost of goods sold times the total cost of goods sold divided by the total number of items sold gives us our unit cost per item. And in this example, the unit cost per item is $349.23 per tablet.